Hey guys, this is Tim Melvin of Tim Melvin Deep Value Report and the Banking on Profit newsletter, coming to you from down here once again in Central Florida. Been very warm down here for the entire month of December, and that's the case again today. Although they tell me we're going to get a little bit of a cooling streak as the new year rings in this weekend. In case you can't tell, I've had a nasty after Christmas cold. Spent most of the last couple days flat on my back, going back and forth between chills and you know the night sweats and all that good fun stuff when you have a fever. Just getting back on our feet, but I can tell you that within a few minutes after doing this video, I'll probably be headed back to sleep for a little while. Anyway, we're going to end the year the same way we started the year. Cash, community banks, and cheap stocks was our theme in 2015. Cash and community banks has worked out wonderfully. The cheap stocks, well, we've lagged a little bit there because we have a lot of exposure to energy and resources. We've cut back a lot of the resources exposure just because the financials were getting worse, not better. We're committed to the energy trade. Somebody said to me the other day, what are you going to do if it goes down to 25? And I said, well, I guess that'll be my next add-on point, because I don't think that even the Saudis, even though they made some noise today about how they're committed to it, they can keep this up. That's fine. But there's already folks in the palace going, we're cutting our budget, we're denying benefits, people are getting restless. So they've got internal pressure, lots of pressure from other OPEC members to get prices back up. And certainly this hasn't worked for them so far, because everybody's matched them as far as production. Russia, the United States, everybody else. And this will go into a suicide spin if it keeps up too far into 2016, and not even the Saudis can handle that. So I think that at some point in 2016, demand is inching up. I think the Saudis and other OPEC member nations are going to have to back off the production pedal just a little bit. We'll see some firming in oil prices, and oil stocks will do real well in 2016. If not, we don't need them to go back to 100, folks. We just need them to stop going down and go a little bit higher. We'll have a good year. If they go back up over 60, we'll have a great year. Whatever happens, we still have tons of cash in the portfolio. I love the way we're positioned in the deep value portfolio. We've got select energy stocks, and I don't want to sound like I own the energy complex. We own oil service companies. We own closed-end funds at a discount, one that owns MLPs, pipelines in particular, and one that owns a lot of major oil stocks. And then we own several oil services companies and companies that supply materials to the energy companies. So we're pretty well positioned in the energy sector. If that strengthens, we'll do real well. If it stays weak, I think we'll still be okay in 2016. We have lots of other stocks in there, some regional banks, some small REITs that trade at pretty tremendous discounts to net asset value that I expect to get unlocked next year, and possibly even attract an activist investor that helps push the values to the forefront. We've got a bunch of closed-end funds at a discount that I'm real comfortable with. The Fed may raise rates, but they're not going to do it real fast. So buying high-quality fixed income assets at a 20% discount to the underlying value does, in fact, make a lot of sense to me, and it's bringing cash flows into the portfolio. And then we even have a small cap value fund at a 16% discount. It's a fund with a long history that's done real well and has thrown off lots of cash again that can add to our cash stockpile in the portfolio. And of course, we have a couple special situations. We've talked about them, thrown them out there for free several times. So I'll mention again that we are really bullish on Volt Information, VISI, and Unisys, UIS, over the next couple of years, and we think that they're going to be really long ball stocks. Love the way we're going into the year. We have almost 50% cash. I bought us down just a little bit under 50 today by buying a small REIT at about 1/3 to 1/2 of the estimated net asset value. It's management's estimate of NAV, not mine, although mine, when I did the work myself, was actually a little bit higher than theirs. We'll go with theirs since it's lower, and it's paying 7.5%. So we're going to get paid to wait for this collection of valuable real estate assets to increase. Love the way we're positioned in the portfolio. It's probably going to be a volatile year, and we'll see how that plays out. We, of course, have the Banking on Profits portfolio. We love it. It's Friday morning when the returns are set back to zero. I'm not going to be happy about seeing that almost 17.5% return in what has basically been a down tape in 2015, set back to zero. But M&A is improving. We've got lots of small community banks under $1 billion in assets that we think we're going to have a hard time remaining independent. They're going to have to grow or sell in 2016. And then we've got those bubble banks that need to get to the $3 billion sweet spot. And once they get there, they have to address the next level of $10 billion. I think an awful lot of them are going to look at the $10 billion and all the increased regulatory pressures and fee cuts that come in at the $10 billion asset level and decide, well, it's been fun. We are going to go ahead and sell our banks to somebody that's willing to go over $10 billion because we're not. That, I think, will particularly be the case with those with older CEOs and older average age on the board of directors. So we've got some of those. We're continually looking for more. We think it'll be another banner year, probably even a better year than 2015 for the community banks in 2016. So we're pretty excited about that. It's last couple of days of the year. The predictions have been pretty steady all month. It's getting pretty crazy this week as everybody is predicting everything. It truly reminds me of a bunch of monkeys throwing darts at a dartboard. A couple of them are going to hit the bullseye, and they'll have as much chance of being right again in the future as that same monkey does of hitting the bullseye with his next throw. Best off, Byron Weens, I love reading them. Doug Cass, same thing, his unexpected predictions. They're way off the wall stuff, and they're just a lot of fun to read, and they're thought-provoking. But I wouldn't trade on them or make any bets based on them because they're just, at the end of the day, guesses. No matter how well informed, they're just guesses. We'll sit back with our cash stockpile and look to take advantage of what the market actually does. We've made a lot more money over my career by reacting to what the market does, buying when it gives us a strong selling opportunity, and selling when it gives us a huge rally to sell into, than by trying to predict what the market may or may not do. And that's particularly true given very uncertain economic activities going on around the globe, stimulus programs in Japan and in Europe. You've got China telling us that things are slowing down, but not too much. Nobody really knows what's going on in China because I'm pretty sure they invent those numbers based on what they would like us to believe over here in the Western world. But China appears to be slowing down. Let's put it that way. You've got really intense geopolitical situations all over the globe. It's not just the Middle East, although the Middle East is by far the worst. You've got some China aggression issues, and China and Japan rubbing up against each other there in the China Sea. The U.S. has been involved to a degree in that. Brazil is an absolute disaster at this point in time. Someday that'll get better. It's going to take a lot longer than I originally assumed. I'm not selling any of my Brazilian stocks, but I'm not rushing to buy anymore either because it is a real economic and political mess down there. So geopolitically and economically, there's a lot that can go wrong in 2016. Making predictions and bets on those predictions is just absolutely foolish. Again, it'd be like betting on which monkey is going to hit the bullseye on that dartboard. It's a game I don't want to play, and I don't think you should either. Where we are right now, in order for us to get fully invested, we need a substantial pullback in the market that creates a lot of safe and cheap opportunities. Now, from time to time, we run across some that look cheap, particularly in the energy patch, by the way, but then when we start digging in deeper, they're not particularly safe. They're too leveraged to the commodity cycle. That's a lesson that we learned very early in 2015 and exited some positions, mind you, at losses, but the companies eventually filed for bankruptcy, so we got some money off the table by refiguring the way we looked at energy companies and margin of safety. We found some, we've bought them. If we find more, we will buy those. We will add to our current positions if oil declines below 30 and then again below 25, but that's kind of where we are. Not a lot of safe and cheap stocks out there. Until there is a sufficient inventory to get fully invested, we're not going to do it. Now more than ever, patience and discipline is going to pay off. It's been several times throughout my career when I was way out of step with the markets, much like I was in 2015. They eventually resolved very dramatically in my favor, and I'm highly confident that this one will as well. So let's see now. Like I said, I don't know when it's going to happen. Certainly this market's overdue for a pullback. It's coming up on 7 years old. You've got the markers in place. Certainly you've got high yield market showing signs of rolling over, the aforementioned slowdown in China. You've got all sorts of geopolitical things that could go wrong. We have no idea what's going to happen as the Fed begins to attempt to normalize interest rates. This has never happened before. We have this much stimulus and accommodative monetary policy in place and then roll back the punch bowl. We'll see how it plays out. I'm not going to make a prediction because I don't have a clue. If, as Charlie Munger said about all this, if you're not confused, you're not thinking about the issue enough. So that's kind of where we are, folks. It's going to be little banks, bubble banks, have a real affinity for some of the small REITs, selected special situations, energy stocks, and a lot of cash going into 2016. I think that's the right recipe. We've got the right mix. If you had the right mix that we had last year, with about 70% of your portfolio focused on the community banks and about 30% focused on the deep value stuff, we've walked out of the year with a return. We beat the market. It wasn't my best year by a long shot, but we did in fact beat the market in 2015 with that mix. So I urge you, if you're not already signed up, take advantage at least of the $279 offer to get deep value free for the year at 30% off, and we'll give you a year of banking on profit monthly. If you'd rather focus on just the community banks, I think that's a solid strategy year in, year out, every year. Then you can get banking on profits right now for 20% off of the list price. I'll clip the codes for those into the description box of this video. I'm excited about 2016. I'm not that excited about the rest of the afternoon because I still feel pretty darn horrible, and we're going to go take a little medicine and take another little nap and see if we can get back on course before this week is officially over. Anyway, guys, this is Tim Melvin of the Tim Melvin Deep Value Report, coming to you from down here on a very sunny, pleasant day in Central Florida, most of the rest of which I hope I'm actually not going to see because I'll be napping until this daggone cold is gone. Have a great New Year's Eve, guys. Be safe, and we'll talk to you next week.